and welcome back to a new video. And as always, if you are new to the channel, a sub would be appreciated, as I do provide valuable content on a daily basis. And if you enjoy the video, please smash the like button for the YouTube algorithm, and as always, let me know in the comments below exactly what it is that you would like for me to cover in my next video. Today we're going to take a look at gold from a technical, fundamental, order flow and sentiment perspective, and I'll give you guys a good idea on what you can expect from gold in the long term. So starting here with the technical data, we can see our gold printed this massive impulse. There we got the correction, but we never got the continuation that we were expecting. So if you take a Fibonacci there from the low to the high, you can see our gold came, tested the 61.8, which is known as the gold ratio in the technical market, and the market had never continued the move to the upside. So normally when the market prints an impulse, you expect the correction, which is what we got, but the market never pulled back. So that is the target that the market is supposed to be hitting after it prints the next impulse. So I'm only leaving that there just so that you guys can get an indication of what the expectation for gold might be. Now, looking at the weekly time frame, what do we see? Now, on the weekly time frame, we can see our gold. We had this very important structure that the market had created over there. Now we can see how we are currently trading above that structure. Now this area acted as a level of resistance there twice. The market broke above that, came back to test its support, did not hold. The market then rallied back to that level, retested it once as resistance again. The market then failed. The market then came back very aggressively and then broke right through it. Now all of this resistance is now once again support. Now what we can also see from a weekly perspective is that the market also has the opportunity of creating this W formation. Now, the W formation is considered a bullish pattern from a technical perspective as well. So there's definitely a move to the upside expected for gold to go and complete the right leg of the W formation, and for the market to also go and print a equal high. Now the situation that we got here on the daily time frame is we saw this market came and printed this massive impulse yesterday. Today we saw the market slightly rising higher to go and test that level that we're at over there as well. The market also completed this M formation to the neckline, and after the market prints an M formation, you can expect a pullback to the neckline before the continuation. Now I've spoken about gold many times in the past. I spoke about gold when it was here even, and you can refer back to the previous videos that I've made, and I explain all of the reasons why we can see gold go and hit that level, and that is exactly what the market did. Now the current price action that we got in the market, we have this impulse where the market broke above that level of resistance. Now we do expect a correction in the market. So taking our Fibonacci there from the low to the high, we can see how the 0.50% Fibonacci is lining up perfectly with structure, which tells us the market after a impulse, you always expect the market to pull back at least 50%, which is a 50% move of this impulse that we had over here. So there's definitely an opportunity for the market to come back, retest that level before the continuation. Now at the moment gold is currently way overbought, so there is definitely a pullback expected before the continuation. Now the market doesn't just pull back because it's sitting at a structural level. There's many things that we need to look at, and most of that comes from a fundamental perspective, because fundamentals drives the long-term momentum of the market and technicals drives the short-term momentum of the market there as well. Now if we look at the order flow data, so the commitment of traders, so what the big banks, hedge funds and institutions are doing in the market, we can see based off the report that was released on the 11th of January, how hedge funds came in and they added they closed minus 6,481 long positions, and they added 5,137. Now if there's one thing that you can take away from this, is that you cannot just rely on the order flow data. Now I've seen many times people say that they've got a COT strategy, like people are starting to make up things where they say that they've got a strategy out of this. There's a lot of things that you need to look at. So the order flow is just one of the confluences that we look at to help us gather the information that we require to make a trading decision at the end of the day. But you can see if you had to do that trading strategy that the people are selling, then you'd have probably sold gold, because why hedge funds was closing their buying positions and they added selling positions. You'd have probably been the person to say, okay, we need to look for swords. And we can see that is not what gold did. But one thing that we do need to keep in mind, that report was released. That's the report from the 11th. So the 11th was sitting somewhere here, and we can see how the market had plummeted that week of the 13th, 14th, 15th, sorry, up until there. So there was a bearish move in the market. Now, we obviously need to wait for the new report to get released, which is going to be on Friday. Now, we'll probably see how hedge funds this Tuesday. Now, just to make you guys, just to give you guys an indication of how this report works. So this report basically tells us what the smart money is doing in the market. These positions that you see here, they get placed on a Tuesday by the the biggest speculators. So these orders get placed in the market on a Tuesday. So this Tuesday, they've probably bought a lot of gold. So they probably bought like a lot of gold. But we will only see that report coming out on Friday. So there is a delay in the data as well. So we can't really just go with the data if the data is 3 to 4 days old after it came out. So you can't really go and say that you can use that as a strategy, because the last thing you want to do is follow just one thing out of there as well. Now, that's with the order flow data. So we can see based off that report, it was came out the 11th, which was on a Tuesday, and we can see how the market had drop over there, but we cannot use that data for next week. So next week's report, you're going to see, for instance, hedge funds came in and they bought gold, but now we're expecting a correction, and I'll tell you why we expect a correction in the market. Not only because we had the impulse in them, we expect a 50% retracement. But the most important thing is what the actual people that are moving the market is doing. So I'm talking about the fundamental data that we have available here as well. Now we can see this article from Bloomberg, that was no from CNBC. It was published yesterday. It says gold off 1 week lows, US rate hike, best bets cap gains. Now, Gates is global auto recovery to drive pickup. Palladium prices, that's got nothing to do with us. This is what we are looking to see. To say that the market eyes the Fed's January meeting that's taking place over here. That's taking place on the 26th. So the FOMC statement, federal funds rate, the FOMC press conference as well. So this is this is basically the gold market is moving on Fed rate expectations, as you can see. So we had that aggressive spike in the market, but we could see how today the market had this sell-off that we had over there. So the market overextended itself. Then the market started the sell-off. Now that sell-off comes basically off the fact that the market is expecting the Federal Reserve to hike the interest rates when they do come in on the 26th of January. One thing that we do need to keep in mind is that if the Feds come in and they do decide, now you have to remember that the Feds were initially going to, Powell came out, and last year in December, and he said that they're going to start slowing the tapering process by March, and then start raising interest rates in April. Then he came back and he said that they might have to start the interest rates hike earlier. Now the problem that we are sitting with now is that the US inflation is at an all-time high. The only problem that we will have is that if Powell comes in and he decides to raise the interest rates this month, as opposed to the initial date that he set out, or that the market is expecting for it to be, which was in April, then this is what's going to happen. If Powell does come in and he raises the interest rates, we can definitely expect gold to drop below 800. Okay, the market's probably going to drop somewhere. Sorry about that. Then the market's probably going to drop somewhere to that level over there. It's going to drop below 800. Okay, that I can guarantee you. Now, listen to what I'm telling you carefully. If the Fed, and I want you to listen to this, if the Fed hikes rates next week, if they do come in, okay, then we could potentially see a sell-off in gold to below $1,800 an ounce. So we could probably see the market come and test these previous lows. We could probably see the market go lower there as well. But it will only be temporary, because the market will know that the Federal Reserve is in a bad position if they have to hike interest rates before March. So if the market does pull back, if the Fed comes out and he says, you know what, we are going to start hiking the interest rates as of this month, it's going to be a bad week, or bad day for gold, bad couple of days for gold. But people or investors are going to become skeptical, and they're going to wonder, but why are you hiking interest rates so early and not in March or April, as you said before? And people get skeptical about this. And as a result of that, they are going to know that something is not right. So they are still going to come back, and they're going to revert to gold as a safe haven. However, if the Federal Reserve comes out next week and they do not hike any interest rates, then by then the gold should have pulled back, because why, investors are still hiking behind the fact that they are going to do it. So gold will slowly pull back as we see it happening. Gold will come back, hit this level. Gold could potentially start that next move to the upside. Okay, it could start the next move to the upside. And when we do meet with Powell on the 26th over there, when the Federal Reserve, speak about the interest rates. And if you look here at the, sorry, at the previous is at 0.25%, the forecast is at 0. So the market is expecting Powell to keep interest rates at 0.25%. Now listen to me very carefully. If the market, if they do not hike the interest rates next month, you can expect the market to go and hit that level. But just be very careful that if we do start seeing this pullback in the market, and they do start they come in next month in February, for instance, or they come in March, and they say, okay, we are ready to start hiking interest rates, then we can definitely expect gold to fall to its knees. Now, one thing that you need to keep in mind, as traders, we have to be reactive and not predictive, and we need to learn to adapt to the ever-changing market environment. Now, the way in which we are going to trade gold as it stands now, because the 28th, the 26th is only next week, so we don't know what's going to happen next week. For now, we're going to wait for the market to pull back to this level and start looking for buys and close that buying potentials before the Federal Reserve, before Powell comes in and says, you know what, we're going to hike the interest rates. But if there's one thing that I want you to take away from this entire conversation, is that remember this: if the Feds does hike the interest rates next week, then something is not right. And yes, we're going to see the sell-off in gold, but the market is going to start buying it at a lower price. And then we can definitely expect gold to start pulling back, because then people are going to be even more skeptical about the dollar as to compared to what they have now. Now let's continue. Now, looking at the sentiment data for this week. So the sentiment data tells us what the retail traders are doing in the market. And it's obvious. You can see how 72% of retail traders are selling the market and 28% of them are buying the market. Now, this is why I say you always want to be on the opposite side of what retail traders are doing. You can see as 72% of retail traders are buying this week, and the market did not provide them any opportunity in the market for that selling opportunity. There was a lot of money made this week from retail traders, because you can see there almost 72% of them sold the market, and the market has continued to the upside. Unfortunately for us, well, fortunately for us, we took a sell probably somewhere there yesterday, still in the sell, um, but that's a conversation for another day. So that's it for today. That's the current situation that we have on gold. And as always, let's be reactive and not predictive. And let's learn to adapt to the ever changing market environment. Now, guys, thank you for taking out the time out of your day to watch the video. And if you find it helpful, share the video with as many people as you like so that you can also help someone else. Because I always say that each one helps one, and the only time that you look down on someone else is when you're trying to help them up. Now, as always, cheers for ears.